Managed futures have quietly become one of the most important diversifiers in modern portfolios. On today's ETF Battles, we compare an audience-requested matchup between two managed futures ETFs, each with very different approaches to the same goal. So who wins the battle? Find out right after this. Welcome to ETF Battles, and I'm Ron DeLegge. It's great to see you again. This is the place where we congregate to analyze and judge ETFs. So keep your excellent battle requests coming. Send me your ETF ticker symbols in the comments section below. And be sure to join our community by hitting that subscribe button and telling your 10 million friends. Today's program is sponsored by Direxion, and they just rolled out 4 brand new single stock ETFs with 2x daily exposure to Adobe, PayPal Holdings, Texas Instruments, and United Healthcare Group. To explore the full lineup, head over to Direxion.com. Today's ETF contest was requested by a viewer named Brian, and this is actually a rematch from an original ETF battle that we did on this same program 3 years ago. And you're right, Brian, 3 years ago is a lifetime. So the rematch is definitely in order. And by the way, that original matchup that we did is provided. The link to that video is provided in the description section below for any engineers, brain surgeons, and architects watching. Helping us to sort through it, and we're going to tap the analytical prowess of two of the best in the business. We've got Shana Sissel, Queen of Alts, with Banríon Capital Management, and Dave Dierking, independent ETF analyst and outside contributor to the Motley Fool. Welcome back to both of you.
Thank you for having me. Love these alt battles.
Thanks. Good to see you guys.
So our 4 battle categories: cost, exposure, strategy, performance, mystery. Mystery battle categories where our judges can pick any factor or criteria that they think is important to today's contest. Our judges can also nominate wildcard ETFs or opt for split decisions. It's up to them. I'm going to keep score, and at the end of the program, we'll declare an overall winner. None of the battle outcomes are ever predetermined or known in advance by myself or our judges. Let's start with that first category, cost. Dave, please kick things off.
Yeah, these two expense ratios are pretty similar. KMLM is at 90 basis points. DBMF is at 85. So not much of a difference there. Obviously, you're not going to find Vanguardian 3 basis point expense ratios with these types of funds. I mean, you're going to pay for what you're getting with these. So on expense ratio alone, DBMF is the winner. It's also got about 10 times the assets under management as KMLM. So that's going to help out with trading spreads and liquidity, obviously. So just another bonus for that fund. DBMF is my winner.
Shana, you're up next. How do you see it when it comes to cost?
So I felt it was important to throw CTA into this battle. I know it wasn't part of the original request, but every response I have, I've included CTA in the mix because it is another very large managed futures ETF that deserves some billing in with these two. So I am throwing that into the mix. It actually has an expense ratio of 75 basis points, so lower than DBMF. It is not quite as liquid, but it does have a sizable investment base of 1.5 billion to the 3.5 billion of DBMF. I would say that it's pretty much a tie between those two, but I give the edge to CTA for being 10 basis points cheaper.
Thank you, Shana. The next category is exposure strategy. You're up. Break it down for us.
Okay. Like I said, I'm treating CTA like it's part of the mix because it should be. And apologize to Brian who put in this battle because I'm taking a little bit of liberty here, but I do feel like CTA deserves to be at the table in any conversation about managed futures ETFs. It's one of the largest ones out there. These 3 have very different ways of going about managed futures. I'm going to give a negative score, negative mark for DBMF in that it is a replication strategy. It is not a managed future strategy. It is replicating managed futures, and I am not a huge fan of replication strategies. Some of them work. This one does pretty well, but you'll see when we get to performance and the like that it takes some liberties here that make it not actually perform like a managed future strategies. And I am a big believer of I want when I purchase something, it plays a role in a portfolio, and I want it to play that role. Outperforming at times when you shouldn't be outperforming, some people might be just fine with that, but it takes away from the diversification benefits of the product and why I own it in a portfolio. So I'm going to ding DBMF for that. KMLM is managed by the Mount Lucas Management, which is the oldest provider of managed futures index out there. The Mount Lucas Managed Futures Index is I think it's the oldest and the original one. Been around since 1988, I believe. It uses a very clear strategy. It gives you exposure to commodities, currencies, and fixed income futures in their managed futures buckets. And it defines what falls into those buckets very clearly. So you know exactly what you're getting. DBMF is the only one of the three that includes equity in that mix. And that actually makes it not managed futures. That makes it systematic trend in global macro. And so it is not managed futures. And it is why it's being dinged a little bit here. It's calling itself managed futures, and it's actually a global macro strategy. And I don't feel like this is the time or place to go down the rabbit hole on what the difference between a systematic trend global macro fund and a managed futures fund is, but just trust me on this one. They are not the same thing.
Style drift.
But also they make a lot more bets on a lot more different areas of the market and are really driven by trend in a way that managed futures is a little different, where it tends to stick with things that trade in a futures exchange that are not equity. CTA is a slightly more diversified managed futures funds where it brings in interest rates into the mix, which I think is really interesting. And it also brings metals into the mix, which is something you don't get with KMLM. So for me, just to have a good mix of diversification in a managed futures product that serves and plays the role of managed futures in a portfolio the way I would expect it to, from like a correlation and all that good stuff. CTA is my winner. But of the battle categories, KMLM is the most pure managed futures, and DBMF it's a completely different animal, and it's not actually managed futures, and is also a replication strategy. So I'm dinging it for that.
Got it. And just if you can just clarify real quick, I don't want to go down the rabbit hole of it, but I think it's worth repeating the difference between that replication strategy versus a real managed futures. If you can,
sure.
If that doesn't take too long.
When I started working in the alternatives world in 2007, I worked for Russell. And one of the first things I was asked to do was to replicate returns of a manager that we had been gated out of and couldn't liquidate. So we were trying to hedge the risk. So we did a regression analysis to figure out what the factors were that were driving returns. And then we bought futures to hedge those. That is a replication strategy. It is taking a return stream. In this case, it is the SOC Gen Managed Futures Index, I think they say. But even that, it's doing something in addition, because that's a pure managed futures. It's taking that return stream, it's regressing it using a statistical model to figure out what the factors are that drive the returns of the index. And then it's buying the factor of futures that it thinks replicates it. So I again, didn't want to go down that rabbit hole because it's a little complicated.
So what you're saying, and just so our audience understands, it's a derivative. It's a derivative of not the actual thing.
It's not actually executing a managed future strategy. The best way to explain it is it's executing a replication strategy using derivatives of a managed future strategy, but it is not actually managing futures in a CTA.
Excellent. The AI prompts are all confused.
Yes.
But we've unconfused them, so thank you for doing that, Shana. This is why ETF Battles, by the way, exists, because we can have these sort of open-ended conversations and really get into the details. So thank you, Shana, for that additional layer of information. Dave, you're up next on exposure strategy. How do you see it?
Yeah, I'm not sure exactly how to follow up on that. This is all an education for me as well, so I'm just happy to sit here and listen. I guess for me, the one thing that I noticed about comparing these two funds, and I know Shana alluded to it, is KMLM is commodities, currency, fixed income, and then DBMF, you have equities in the mix too. So I think from a standpoint of what you really want the strategy to be, I think you want something more like KMLM. if you look at asset correlations, if you look at returns, the equities have really influenced those over the last few years. So performance is going to look a lot different. I don't want to jump ahead here, but I think just purely from a standpoint of kind of what you want this strategy to be in your portfolio, I think you want something more like KMLM, which has just the exposure to commodities, currency, and fixed incomes, because I think that's going to be more of a diversifier and more like a true strategy of what you want these to be. So KMLM is my winner.
Excellent. Thank you, Dave. And I agree and concur with you, is to think about these ETFs, and not just this battle, but all of these ETF battles that we do on this program in the context of the other holdings of your portfolio. And our judges are already bringing that out. So appreciate those added points. That takes us next to performance. So Dave, you're still up and you already alluded to it. So give us your analysis.
Yeah, if you just look purely at returns, DBMF is the clear winner here. Over the last year, it's returned 28% versus 14% for KMLM. 3-year, I've got 10% average for DBMF versus 1% for KMLM. So just on a pure numbers basis, DBMF is clearly the winner, and I'll call it the winner just because of that. But again, when you've got the exposure to equities futures in the fund, I mean, obviously that's been the asset class that has been driving returns in just about everybody's portfolio. So it's not surprising that you see that helping to drive bigger returns here. So again, the future may be different. The past is, what it's done in the past. So we'll call DBMF the winner here just based purely on the numbers.
Shana, you're up next. How do you see it when it comes to performance?
So yeah, Dave kind of alluded to it. If you were to look at DBMF and then you were to look at the equity markets, you see that it's highly correlated to equities. So right now, as of the 1 month as we are recording this, it is the worst performer. And it's the worst performer on the 3 months. And the equity markets have been difficult. When you go and you pull back, when equity markets were raging, it is crushing everybody else. And that is the equity exposure. It's typically not why you own managed futures. And this is, again, gets back to this is a systematic trend global macro fund and not a managed futures fund. They're not the same. And it's using replication. Again, not the same. I want to own a managed futures fund because managed futures is almost like insurance to your portfolio. It's almost perfectly negatively correlated to equity markets. And that's why I would own managed futures. I wouldn't own it for any other reason. And a managed futures fund that is highly correlated to equities is not useful to me. So even though, to Dave's point, if you look purely on the numbers, DBMF as the winner, I want a managed futures fund that acts like a managed futures fund and that diversifies and provides the low to no correlation with equities and fixed income that I would come to expect from my risk management insurance in a portfolio. And that's why I'm going to throw CTA as my winner. It is a pure managed futures fund. It outperforms KMLM over, especially that 3-year number, it crushes it. It actually holds up quite nicely over all time periods. The only period CTA does not outperform all of the other two is the 1-year number. And that is directly related to the fact that DBMF has equity and CTA does not.
Shana the Purista, besides being the Queen of Alts, speaking. And this is an absolute clinic on managed futures. I hope you're enjoying it as much as I am. So that takes us next to the mystery battle category. This is where our judges can surprise us. I call it the Alfred Hitchcock category because it's a mystery. And our judges will give us their factor that they feel is important in today's contest. So Shana, what's your mystery category or factor, and which of these ETFs takes it?
So I'm just going to give a little education on managed futures and CTAs and what they are to begin with. So a managed futures product is a very specifically defined product. It should be managed by either a CTA, a commodity trading advisor, and it should have a commodity trading pool, a CTP. And almost always they are located in the Cayman Islands, Bermuda, offshore for tax reasons, so on and so forth. So almost every CTA or managed futures ETF that exists on the planet has a Bermuda-based offshore CTA that is the underlying investment of the product, and that helps manage the taxes. in this case, DBMF, because it's a replication strategy, it's not a managed future strategy. It does not invest in commodity trading pools. I think it says something about having something in Bermuda, but it's very like opaque. For that reason, again, not a managed futures fund. It's a systematic trend global macro fund, and I stand by that. It has a role, and they are similar, but they're not the same. From a mystery battle category, I just want the audience to know the reason you would own managed futures in a portfolio, because this is really the only reason you'd own it, is because they typically don't do well when the market's doing great. It is the definition of always having to say you're sorry for diversification. It is like insurance. When flood insurance is, you don't think you need it until the flood happens. It's kind of the same thing. That is its expressed role that I would use it in a portfolio. And so I would pay attention to wanting to actually have those attributes in a portfolio. It's not to say that you can't own global macro or something else. It's just that's not the role those things play. In this battle, we're talking about managed futures. I'm going to focus on managed future funds, KMLM, CTA. I'm going to give it to KMLM here just for being the granddaddy of managed futures, liquid strategies for people to invest in. So I'm actually going to give them a nod here. That is the original. That's the one that made these possible to advisors and retail investors to even access this type of strategy. And so I'm going to give them props for being the granddaddy of all and managed futures, and give KMLM my win for the mystery battle.
All right, Dave, you're up next. What is your mystery factor, and which of these two ETFs takes it?
Well, I think we've both kind of alluded to this already. I just wanted to make note of the asset correlation issue that Shana just talked about. But I agree exactly with what you said. KMLM, with its non-equity exposure, if you look at historically the correlation to the S&P 500, it's about negative 0.5, which means the S&P 500 goes up 1%. This can be expected to go down 0.5% and vice versa, which is, it's been pretty consistent over time, although it's bounced around a little bit lately. But again, with a product like this, that's kind of what you want. You want something that's going to zig when the market zags, and vice versa. If you look at DBMF's correlation to the S&P 500, it's been much less negative, to the point where it's actually turned quite positive over the last year or so. And again, you've got that equity exposure in there. It's sort of following the S&P 500 along. So, you might like that from a total return perspective if the market's going up. But if the market's going down, it's kind of suggests that, it may provide you a hedge. It may not provide you a hedge. It's just when you got the equity exposure in there, you're kind of, you've got something that doesn't necessarily provide you some of the protection that you think it might. So, again, I think KMLM does a better job. It's a better diversifier in the purpose of what it's trying to do. So that's my winner.
All right. We've moved to the part of the program where our judges are going to give us their overall battle winner. Dave, give it to us.
Yeah, I'll keep it quick and simple. KMLM is my winner for the reasons that we pretty much just touched on. I think it does a better job of being inversely correlated to equities. It's got a big mix of different asset classes outside of equities, more of a pure trend following strategy. I think it's more true to the purpose of these funds. So KMLM is my winner.
Got it. Shana, your final chance to weigh in with your overall winner.
I'm throwing in CTA as my wild card and my winner of this battle. It is a pure play managed futures. It's diversified further than KMLM. It's cheaper and it performs better. So CTA is my winner. But I do give props for KMLM because Mount Lucas is the granddaddy of managed futures, and CTA would not exist without Mount Lucas. And so I tip my hat to the folks at Mount Lucas for making it possible for these strategies to be available to everyday investors.
Well, our judges have spoken, and according to my battle scorecard, today's winner is a split decision between CTA, that was Shana's wild card choice. She turned this into a triple header from the very start. And that was much appreciated. And then giving ETF Battles some hot sauce. I love it. And then, of course, Dave opting for KMLM as his final choice. Some really good points by our judges across the board. negative correlation to S&P 500 or broader equity market. That's why you own managed futures. So, and I thought our judges pointed that out so very well. And global macro got no love on today's program, but that's nothing against that specific strategy. It's just in the context of what we're talking about here, managed futures. It's not what you want. So our judges did a great job of pointing that out. Very entertaining and educational program. Great job to both of you. We couldn't have done it without you.
Thanks so much for having me. I love these alt battles, and I no shade on the folks who run DBMF. I think you are a great global macro manager, but this is a managed futures battle.
Thanks. Good to see you guys again.
Well, be sure to hit the comment section below. Let us know how you enjoyed today's contest. And while you're down there, give us your next ETF battle requests. What do you want to see on the next program? We do double, quadruple, and triple headers. So give us your best ETF matchups, the ones that maybe you need some help with, or maybe you're just looking at a specific ETF and you want us to analyze it. We could do that. So again, hit us up in that comment section below. A big thanks again to Dave and Shana. We've got links to both of them in the description section, so get in touch, along with our program sponsor, Direxion. I'm Ron DeLegge with ETF Guide. Thanks for watching ETF Battles. We'll see you on the next battle.